Welcome back to another episode of With Sonar. I'm Luke Velasquez, of course, joined by my co-host Kyle Taylor, and we are excited to be back again at another event. They keep calling us back for these events, Kyle.
Get that lefty out of the bullpen. They keep calling us to come to the appearance of, what are we at, the Oil and Fuel Summit here.
I know, man.
We're going to get to talk a little bit about what's driving the industry here, what's being put in the vehicles. You love to hear it. You've seen it here first on With Sonar. The first, forgot the word. It's fine.
Dad jokes, we don't need that.
But no, I'm glad to be back.
So we just lost half our viewers.
We're back here, and now we have the true viewerships.
Yeah. What do you know about the oil and gas industry?
See, that's a tough one. I know I put oil in my car. I know that
you put oil in your car. Well, I guess you do.
I put a derivative of oil in my car.
Technically, there is some oil.
A portion of the crude oil that they take out and put, and that's all I really know.
So basically nothing, and I know even less than that. So fortunately for us and our viewers, we have a very special guest joining us today to enlighten us with how this industry works, and also, but more specifically, how it relates to actually the trucking industry, because there is fuel surcharges. There's a lot of stuff based on obviously diesel prices, but also oil. So what we're talking, last week we talked a lot about the upstream and downstream effect of how ocean freight can have a really big impact eventually on the trucking and transportation industry domestically. So and we're going to talk a little bit about that today. So. Please welcome, we are joined by very special FreightWaves employee, executive editor, John Kingston, our oil market expert. John, how are you doing today?
It's great to be back on With Sonar after about a year, I think. It's been maybe more like 13 months since I was down in Chattanooga at the end of January 2020, and the coronavirus was just starting to become an issue, and we talked about it on With Sonar, and little did I know that would be the last time for 13 months.
That's right. Well, here you are. And while you're still not back in Chattanooga, we've at least got you on the air here with us. But always good to have you. John, just obviously we know who you are, and a lot of folks, read a lot of your content that you put out on FreightWaves.com. But just give folks 20-second overview of your background and what you cover in the industry.
Well, right now I'm more. I do whatever oil needs to be covered at FreightWaves. I do cover, though I do spend more time writing about trucking and freight related issues. But background wise, I worked for almost 30 years for a division of what was McGraw-Hill and is now S&P Global called Platts. It is a news and pricing service. Then I went over to the corporate side for 3 years, the corporate parent, and before I got brutally reorged out, but swooped up and came to work for FreightWaves. But even when I was on the corporate side, the job I had dealt with the oil industry as well. So really, I've been dealing with oil now for 37 years, something like that. So I've been watching the market that long.
Good stuff. And we've seen, obviously, on the transportation side, there's been a lot of volatility, but there's also been a lot of volatility on the DOE as well. So the price per gallon of diesel that we've seen. But before we even get into that, kind of walk us through a little bit about what impact what sort of impact when oil prices fluctuate, what kind of trickle down that has towards the price of diesel.
Well, one thing that kind of fascinated me as we record this, the DOE price has been up 17 consecutive weeks, which is a record. The series goes back to 1994, and this is the longest. The previous longest was 15 weeks. So we're at 17 weeks now.
Let's go. Can we put that on the screen too?
Yeah, what I found fascinating about this is that there is very little pushback in the industry. You're not hearing talk about, oh, this is a real problem for us, this is a real problem, which to me kind of affirms the idea that the fuel surcharges are kind of working as they're supposed to. The idea of fuel surcharge is to take that cost of fuel for a fleet and put it really right through as a kind of variable, a fluctuating number to the shippers. So this is absolutely affecting the shippers. And when you looked at the earnings reports from some of the really big shippers in the recently completed quarter, they made reference to their shipping costs going up. So they are certainly paying it. I'm sure that there were some independent owner operators, who may have accepted a rate assuming some price of diesel, and then they were kind of surprised to get out on the road and find a higher price of diesel. But given that this is not a big deal in terms of the trucking industry itself, I think it's kind of like, my background is not in trucking, but this is kind of my introduction to the idea that maybe these fuel surcharges are pretty well structured and are doing exactly what they're supposed to do, which is to put that cost onto the shipper.
So just to provide a little visual here for our viewers, we've put this on the screen. So the blue, we're looking at this is over the last year. So that blue line that you see there, that is the price per week of diesel here in the U.S. So you can see there, right about, the first or second week in November is right when things really started to go up. And we've seen, just as John said, 17 consecutive weeks. I mean, we went from about just under $2.40 a gallon to now we're almost $3.10 a gallon. I mean, that's pretty.
All the charts on diesel right now show that we've basically recaptured everything that was lost during the pandemic.
Right.
So I would say that any declines from here, I would view as sort of new declines. I would not necessarily view them as pandemic related. So we recaptured all the declines from the pandemic.
Right. And so kind of taking this into a different note, something that we brought up last time you were on with us, we were talking heavily about the IMO 2020. How did that shock you how little people were going to talk about that going into 2020 with this whole pandemic?
Yeah, of course. I wouldn't have expected it, but the pandemic really made it a moot point. So just to try to summarize, the global marine shipping industry had to go to a much tighter sulfur spec on all marine fuel starting in January 1st, 2020. It's a kind of a long, complicated thing that I won't go through here, but the molecules that make up diesel demand were expected to be the savior of this. That molecules that would have gone into producing diesel were expected to be diverted into making this low sulfur fuel. Well, what happened is because of the collapse in demand of diesel molecules, and remember, diesel is very similar in structure to jet fuel, and of course, jet fuel demand totally plummeted. You actually had a lot of molecules out there. And so the number of molecules needed to meet the IMO 2020 spec, there turned out to be plenty of them. And it really wasn't quite that big a deal. Will we ever know if the pandemic hadn't hit? Would it have been a problem? I mean, I guess I could say that, we'll never know if I was right all along, thinking it was a problem, right? I can claim that, I'm sure I would have been right, But so that's really what happened. There were just so many excess diesel molecules, distillate molecules that could go into the production of IMO 2020 compliant fuel that it really didn't become an issue. But I would not have thought that at the start of 2020, but I also would not have thought that we were going to have a global pandemic either.
Yeah, we probably would not be sitting in our seats if we foresaw that to be
coming.
We may have made some different decisions along that path.
Not that fuel change has really had much effect on the ocean carriers' bottom line. As we've seen, as we looked last week, the price of containers has more than 3x'd since this time last year. So they're doing just fine.
Yeah.
Right.
It's almost like the regulated.
Fuel continued to be just like a pass-through charge.
Yeah.
I mean, it's just something that you just kept passing on to your customer.
Yeah, IMO 2020, I think the final rule was established in 2013, giving the industry years and years to get ready for it. And it's almost like the planners knew, we're gonna have a global pandemic, so it'll make the transition easy, and we'll also have insanely high container prices, so the cost of the fuel will be almost minuscule, minor compared to the overall cost. You really couldn't have had a better scenario for bringing in this radically different fuel than you had in 2020.
And so as we reopen back up, the price of fuel is really, dictated by supply and demand. How many barrels are coming in, and how much fuel is being absorbed by the consumers. Do you see us going back to normal, I guess you can call normalcy of pre-COVID, causing a lot of this demand, or is it just that we just don't have the supply coming in like we used to?
Well, let's talk about some bigger macro issues. Right now, virtually every commodity market is blazing hot. I saw a very good graph the other day comparing the price of oil to the price of a whole lot of other commodities, copper, lumber, some grains, and actually oil had moved up less than any of them. So we are in the middle of a great commodity surge. Earlier this week, the commodity staff at Goldman Sachs, which is really well respected and people hang on their every word, they think that we're in the middle of the start of a great commodity bull run. It's if you take the commodity collapses dating back to, let's say, 2014, we're 6.5 years into that. That's kind of short for kind of these long run bear markets. But if you say we've had a 6.5 year bear market and now we're ready to reverse, that's not crazy. And the one thing that they said, that Goldman Sachs said and others have said, is that basically every commodity right now is in deficit, that the amount of supply is not adequate for demand. And that's one of the reasons you're seeing it high. And I was looking in preparation for this at some sort of amazing numbers. The production by OPEC right now is about 24.9 million barrels a day. There is a figure out there that projects what OPEC needs to produce to keep the market balanced. And by the third quarter of next year, that number is 28.1 million barrels a day. So you're talking about more than 3 million barrel a day deficit if nothing else changes by the third quarter. So, you can see that kind of supply demand imbalance that's really leading to some of these price increases. You're talking about Brent, the worldwide benchmark, that bottomed out about $20 in April, and now it's solidly over $65. So you see how far we've come. And right now, the supply demand balance for crude oil going forward without any changes will call for higher prices.
It'll be interesting to see too how that continues to unfold and affects fuel surcharges in the industry. I mean, obviously, fuel surcharges are continuing to go up as the price of DOE goes up, and not that carriers need much more help with already rates that are that much more elevated, so they're getting an extra cherry on top.
Well, let's also realize who's actually going to be affected by this swing in diesel price. It's not necessarily the UPSs, the FedExes, these large trucking companies that do have a rack price or a pre-negotiated price that they really can just get a steal for this on a per barrel basis. But also, it's the other guy who's paying the retail. Right. Who's constantly having to dictate, okay, am I going to turn left here or am I going to turn right here, depending on just the price that's posted on the signs. Yeah. And so that's going to be, go ahead, Kingston.
Yeah, I was going to say right now, the entity in the freight industry that's probably most jumping up and down and excitement about this would be the intermodal railroads, because that, of course, is one of their big advantages. It's far more energy efficient to move a ton of freight by a rail than it is to move it by a truck. The problem, of course, is that it's also not as quick and it does not as direct. I mean, we all know the cost benefit comparison of going onto the rails rather than trucks. So, but when the price of diesel starts to rise, when it gets really, really high, then that cost advantage of an intermodal operation really stands out. So that is the one part of the freight supply chain that is just loving this.
And we've continued to see too, like on the intermodal side, like volumes have been ticking up a little bit. They were lagging behind truckload by quite a bit, but they have continued to catch up a little bit and close that gap, especially on the 53-foot intermodal side. When we look at that container movement, especially coming out of Southern Cal, when we look at the Port of LA. Right, a lot of intermodal movement going up, especially going to Chicago or going to Dallas.
Well, to your point, so let's just talk in kind of some what ifs. I mean, if trucking rates start to come back down, let's say a softening occurs, like we're all starting to, everyone starts to or is sort of predicting. This might be a secret hand kind of keeping that rate high, because the rate per gallon is so high, then your fuel surcharge is going to go up. So even though if maybe your line haul rate starts to cheater down a little bit, that fuel might be coming up. And to Kingston's point, that's going to be something that could still maintain this rate per mile on the contract side of the freight market.
It's going to be interesting. Zach Strickland, our colleague with FreightWaves, has done some very good work showing the correlation between freight rates and diesel prices to be pretty tight. And so how much can they diverge? I mean, if you're about on the verge of, a relatively significant downturn, won't put numbers on it, but let's say you've got a downturn in freight rates, can diesel continue to drive higher? There are two factors here. There's the price of crude, which is the primary factor in determining what the price of diesel is. But there's also a spread between diesel and crude. And when we opened up 2020, that spread between diesel and crude, if you normalize crude to a cents per gallon basis, and then you compare that to diesel cents per gallon, that spread was about 45 cents. And it got down at one point during 2020 to 4 to 5 cents because the world just produced way too much diesel that it didn't need. It's now back to a little more normal level, more of like 30, 35 cents a gallon. For it to have a kind of situation where crude rises and pulls diesel with it, and diesel freight rates go down, that would be divergent from the work I know that Zach has shown, which is pretty consistent. And you wonder how long it can hold, and then you also wonder how much can diesel, let's say, drop faster than the price of crude might be dropping, or if diesel's going up and if crude is going up and diesel doesn't go up as much. So there's that second spread that's relevant to the price that's getting paid.
Right. And so with trucking rates where we're at now kind of softening as well, what are some of the impacts that you saw coming out of these freezes that happened in Texas? I mean, Texas being really known for a lot of fuel and a lot of fracking. What do you see as a short-term sort of forecast coming out of that freezing event?
Well, we know what happened. I mean, refineries all along the Texas Gulf Coast shut. They're not fully winterized. They're really not prepared for this. I haven't seen all the data yet about how much production we've lost. When I say production, I'm not even talking about upstream production, though we lost that too, but just talking about diesel production. That's something to keep our eye on. I know that there was a big drop in reported output a week after the freeze. We'll see what happens in the next round of data as it's released. So there's that concern. I've got a little longer term concern because from being around for a while. The last big freeze that I remember, I know the press coverage has talked about a 2012 freeze, which I really don't remember, but there was a really bad one at the end of 1989. In fact, on Christmas Eve, I know because I wrote a story at home on Christmas Eve to get out onto our system. There was a refinery that it failed. I think it exploded. I can't remember exactly what happened because of the cold, because it was that cold down there. And there was a talk that a lot of refineries after that freeze just didn't work right for a long time. They didn't just snap back because the temperature climbed back to normal. So I think you kind of got to take a little longer view and look at what refinery throughput is and how much crude is going to get put through refineries in the coming weeks and months. And does it look like there's a return to normalcy? And if there's not, you got to wonder, is it because some refineries are just not back at normal?
That's a good point, Kingston. And I know, and definitely a valid concern. Now we're getting closer towards the end of time. So we're going to have to close here in just a minute. I guess one last point, if you could give us 15 seconds, on this, we're going to go out into the weeds here for just a minute. Do you think as the electric vehicle market continues to come in, could that be playing into why Wall Street maybe isn't valuing oil as a commodity compared to some of the other commodities? Is that on their radar?
Yeah, I think the end of oil has maybe been a little oversold. Right
Sure.
now, the fact is, if you bought some oil stocks in October, you've done very, very well. But, it doesn't take, in any kind of a commodity market where you're balanced on the edge, where supply and demand are in balance, you don't need to take a lot out of either side of this to be really disruptive. And let's say you had 10% of what's now a gasoline fleet go over to electric vehicles. That's not insignificant. You're taking a couple million barrels a day of demand out of the market. So I think the EV penetration, it doesn't have to be 50%. It doesn't have to be 75% or whatever. You get 10, 20% of the market going to EVs over the next, 10 years. That is a significant chunk of oil demand. And I think that a lot of people are concerned about that. There's the whole, oil's yesterday's fuel, but it's more than that. I mean, you do have short-term disruptions.
Sure. No, that's good, Kingston. Well, Kingston, thank you so much for joining us today. We appreciate it. And thank you again for our viewers. We've got more good stuff coming up for you for the next evolution of oil coming up next. And everybody, stay tuned. We're coming up soon. Have a good day.